Yesterday really was an indiscriminate selling day. Did Tesla's valuation and fundamentals drop 15%? Did the broad market have a 4% decline in valuations? To us, it really looked like a lot of liquidation. I think investors are, of course, reacting to the White House warning of pain ahead, but it has been more of an equity sell-off than it has been in corporate bonds. So to us, 4% down days, I think it's an overreaction. And for a while, markets ignored those tariff headlines, and now they're taking it very seriously. But I think at the end of the day, if we take every headline at face value, then markets are completely paralyzed. And of course, that again creates opportunity because at some level, all these stocks are really attractive opportunities, especially something that's had a 50% drawdown.
Markets are rattled, fear is rampant, and investors are panicking as stocks plunge dramatically, weighed down by trade wars, tariff headlines, and growing whispers of recession. However, seasoned Wall Street strategist Tom Lee of Fundstrat argues that this sell-off is an exaggerated overreaction. While equities have tumbled, bond markets have remained relatively stable, pricing in potential Fed rate cuts due to easing inflation pressures. Lee believes investors are misreading short-term noise as a long-term disaster, wrongly assuming the economy is heading straight into recession. In his view, the current market declines are not driven by deteriorating fundamentals, but rather by emotional, panic-driven selling, which has pushed valuations into deeply oversold territory. He sees these moments of fear as golden opportunities, rare dips that investors dream about, and often wait years to capitalize on. According to Lee, stocks with strong growth and intrinsic value are now available at significant discounts, poised for a major rebound when sentiment inevitably shifts. Investors who take advantage of such indiscriminate sell-offs often reap outsized rewards when the market recovers. One stock that stands out in this downturn is Broadcom Incorporated, AVGO, a heavyweight poised for explosive growth. Broadcom is not just another tech giant, it is strategically positioned at the heart of the AI revolution, providing critical infrastructure and specialized semiconductor solutions essential for the world's largest tech powerhouses. With AI-driven revenue soaring 77% year-over-year, Broadcom has rapidly become the go-to supplier of customized AI chips and high-performance networking silicon, powering hyperscalers like Google, Meta, and ByteDance. Reuters has recognized Broadcom as the single largest supplier of bespoke AI chips to big tech, highlighting its dominance and the vast opportunity ahead. Beyond semiconductors, Broadcom boasts a diversified business model, including robust infrastructure software segments that provide recurring, high-margin revenue streams. This dual powerhouse approach insulates Broadcom from the volatility often associated with pure semiconductor players, positioning it to weather economic uncertainty and profit from the ongoing AI investment boom. Financially, Broadcom's strength is undeniable, consistently delivering stellar gross margins in the high 70% range and generating extraordinary free cash flow margins of nearly 40%. The company's strategic acquisition of VMware further amplifies its potential, unlocking $1 billion in incremental revenue and opening up vast cross-selling opportunities through private AI clouds. With hyperscalers like Google, Meta, Apple, and ByteDance demanding increasingly powerful AI chips and advanced networking infrastructure, Broadcom's growth trajectory appears unstoppable. Currently valued around $1 trillion, Broadcom's stock has significant upside potential. Even conservative projections suggest it could surpass the trillion-dollar threshold again, driven by persistent double-digit revenue growth and market leadership. Investors who seize this panic-driven sell-off are setting themselves up for extraordinary gains when sentiment shifts, making this dip an opportunity too good to ignore. Another compelling stock in this market downturn is Taiwan's semiconductor manufacturing company TSMC, a dominant force in chip manufacturing and a cornerstone of the AI revolution. While geopolitical tensions, tariff concerns, and short-term uncertainties around AI chip demand have caused turbulence, TSMC remains incredibly well-positioned for long-term growth and value creation. Recent financial updates reaffirm its resilience, with a staggering 43% year-over-year revenue increase in February alone, reflecting sustained strong demand for its industry-leading chips. Despite challenges such as tariff pressures and a recent earthquake that briefly disrupted operations, TSMC is on track to meet or even exceed its revised first-quarter revenue guidance of around $25 billion for 2025. The long-term bullish case for TSMC is underpinned by the rising demand for next-generation AI chips. While current generative AI models like DeepSeek appear efficient, their limitations in deep analytical thinking mean that demand for more powerful, specialized GPUs and chips will inevitably surge. The development of advanced AI reasoning will require exponentially greater processing power, chips that only TSMC can reliably produce at scale. Global semiconductor sales have remained strong, rising 17.9% since January, signaling resilience despite broader market fears. Analysts widely agree that high-end GPUs and chips from TSMC are indispensable to AI's continued evolution, ensuring that long-term demand remains intact. Currently trading significantly below its intrinsic value, TSMC offers a compelling buying opportunity with an estimated upside potential of around 40% from current levels. Investors who act decisively now amid temporary market uncertainties stand to benefit immensely when the market fully recognizes TSMC's critical role in powering the most advanced AI technologies of the future. Lastly, Supermicro Computer Inc., ticker SMCI, emerges as another standout opportunity in the AI-driven market sell-off. Despite recent market volatility, Supermicro remains fundamentally robust, showcasing exceptional revenue growth and a relentless pace of technological innovation. The company's recent earnings report reinforced its strength with a remarkable 55% year-over-year revenue surge driven by heavy investments in R&D and manufacturing expansion. Supermicro's growth trajectory is closely tied to the booming demand for AI solutions, particularly given its close partnership with industry leader Nvidia. Projects such as the ambitious Stargate initiative, which is expected to require tens of thousands of advanced GPUs by 2026, further highlight the company's positioning at the forefront of AI infrastructure. In short, today's market fear presents a unique opportunity for savvy investors to position themselves for substantial future gains. Broadcom, TSMC, and Supermicro are three companies uniquely positioned to benefit from the ongoing AI revolution, making the current market dip a moment of opportunity rather than distress. Those who act decisively amid uncertainty will be well rewarded when sentiment shifts and the market rebounds.